Welcome to the Twomey Stock Market Report. Today is Wednesday, February 14th, Valentine's Day 2023, and I'm James Twomey for a quick update on the stock market and what we are seeing, and more importantly, what's coming next. So let's take a quick look here for the 14th of February. You can always get more detail if you go to my website, and that's the number 2, mestocks.com. And there you'll get all the information, our weekly newsletter. You sign up for our trade tracker and our stock alerts, etc. So go to that website. You can check it on a daily basis and see what's updated on the videos on the front page. Also, what's happening in the marketplace? Well, today the consumer price index came out, and that was pretty well expected to be a fairly benign in the case that not much increase month over month or year over year. As it turned out, economists are looking for 0.4% and month over month and 6.2% annual. It actually crept up to 0.5 and an annual gain of 6.4. So a little bit hotter, saying that the cost of food, rent, and to some extent also utilities were much higher than anticipated. And there's no surprise there. I mean, what we talked about in our market report last weekend was the markets, the traders are all starting to realize that inflation is going to stay at these elevated levels probably well into next year, 2024, and that the market has to either absorb that, take that, and the way we're handling it is all coming down to the fact that people are working, even though they're cutting back in all areas and not buying certain goods, they are surviving. Now, if that changes and we start losing jobs, and all while the economy is slowing, you're losing jobs. There won't be places for these people to go to work, and then they'll not be able to pay these high prices. And what's happening is, with all these stimulus and all these dollars out there, it's causing this rapid inflation. And the inflation, although right now people are working, that inflation is impeding economic growth, and companies are pulling back, and they're borrowing, they're hiring, and also more they're spending and building up inventory and supplies. So that's all going to be a drag on the economy. So what happens? Start getting into what they call stagflation. We're not there yet. We're leaning towards that as a premise coming up later into the year, but we will see, and that all depends on how much inflation impacts the employment market. Okay, so what did the markets do? They were testing the highs, right? We talked about that. We had elevated RSIs. It abated a little bit last week. Prices did come down, and they were saying, okay, will the SPY, the Diamond, the small caps, and the NASDAQ all retain their first, on the technical trader's point of view, their first lines of defense, and more importantly, the 50 EMI exponential moving averages. And we felt that if it could at least move sideways, and get through this negative news, if the CPI came in hotter, which it did, that would be a bonus for the market, because that means investors would be pushing their money into the stocks. They're willing to hold it, and they're more buoyant about the outcome of the future versus trading on the first sign of bad news. That reactive trading phrase that we were going through end of November and then mid to December to early January, where it was like news, one day we're up, one day we're down, and it was a lot of fast trading and a lot of fast losses. So we're going to look at the charts. We'll go into a little bit more detail. I did alert subscribers the last couple of days. We're adding to our positions. We do feel safe enough to do that, and of course we've gone into a little bit more defensive posture on some of our sectors where we're looking for high dividend plays to get a nice base and a nice annual dividend to add to any particular stock pullback. So let's see what our charts are saying. I want to first go into advanced decline. Advanced decline, I like to look at that as a little bit more longer trend. We hit this peak a couple of weeks ago, and it started pulling back, but that's at the same time we did the golden cross of the 50 crossing above the 200 exponential moving average. Again, that shows us that the short-term traders, the 50 days He was looking at the amount of trades that very positive in the last 50 days. New York Stock, the NYSE is a large basket of stocks. To move this momentum up or down, it takes a lot of stocks, right? So we're not looking at a very small snapshot. So very positive. We said the last time it was up here in August, we had a bear market lows. Bear market highs on that rally, and then we subsequently were up in a high RSI. We were peaked out, and once it's turned down, we had a tumultuous sell-off all the way into to mid-October. So we don't see that happening now. What we're seeing is a little bit of a pullback, yes, leveling, yes, but the RSI was up to 75 a couple of weeks ago, and now it's down to 60. It was 56, I think, closed last week. So we're abating the pressure of oversold, where everybody's had gone in the store and they bought everything, and then you turn around, there's no one else left to buy. Well, stocks come down. Well, that's not the case here. And then in addition to that, look down here at the MACD. The MACD is the moving oscillator of momentum. That's what we look at it over, algorithm of time. And what's seen here is that the fast cross below the slow. That's telling us there's more selling ahead, weakness in the market, but yet is still in positive territory. It takes a lot of momentum to get into that positive territory. And if we can hold that for a much longer period of time, that means stocks will level out, go sideways, and potentially another advance, right? Well, if you look back here at the bear market highs, what happens? That's that fast oscillator, which crosses below the slow, and that indicates selling is starting to take place. Holders are losing their faith in stocks and selling, and sure enough, look at the advance decline. More declines versus advances, right? And it went straight down. Once it hit zero, or my neutral line, it was about this low here. We had a little bit of a rebound, but then it hit to lows. So, usually when it gets near that, near zero, we want to be prepared to sell or get out of our positions, because it's most indicating. And when it does cross below zero, look at here. It went from mid-September all the way to mid-November. That's a long period of time of negative holdings. If your stock's down, that's where you lose a lot of your position worth if you're holding a long position. So right now it's holding. That's very encouraging. So we want to look at the charts to look at the S&P or SPY. We use the SPY as our S&P proxy. And what we're looking here is, yes, it did pull down to the 14 EMA the end of last week. We've had 3 days where it traded up, and now it's above the 9. So we were looking at, will it hold at the 50 EMA? That's that pink line, or 200 EMA, which on the moving averages, the 50 is already crossed above. Moving average is just a smooth average of 50 days, or 200. The blue is 200, the red is 50. But the net of it is the exponential puts a little more weight on the most recent trades, on that algorithm that they use to calculate those numbers over that period of time. But that said, we've got quite a difference. That 400 to where it closed today, which was on the S&P, which is high at 415, and it closed at 412. So we've got 12 points there. That really is a good gap between the 50. So we could have some selling, but I think what we're going to see as we look at the MACD and stochastics flattening out here, it may follow what the Dow Jones followed. We've used the diamonds as our proxy for that. And what we saw with that back here in mid-December, yeah, we had that pullback. Yes, we had the sell signal cross, but it held pretty much at the 50 or 200 EMA, rebounded, and then it's been basically sideways, right? And at this stage, it's holding pretty good ground. Which is very encouraging, because if the NASDAQ and the SPY hit the same type of resistance, we're not seeing a cataclysmic sell-off. In fact, we're seeing much more people hold. And what's that telling us is less short traders in the market. They're not trading shorts, okay? So they're not adding shorts to their portfolio. So the bottom line is, if you look at, we use XLK for a NASDAQ, that's still been the leader, where people went into high beta, high growth stocks that got beaten down last year, they're holding their positions also too, and that's after negative news. CPI was very, negative. So potentially the next couple of days we'll see a pullback, a sell-off. I expected it bigger today. It did start off down quite a bit this morning, and then it rebounded, and everybody was positive except for the Dow Jones. So that's very positive. The next couple of days, look for some potentially lower numbers. Good time to add to your positions, and that's where our premise until we see some other technical indicators tell us differently. But it looks like the market wants to advance or at least go sideways. If it's safe trading for the next several days, we'll keep you posted. Go to the number 2 mestocks.com, and there you can get all your information and sign up for any more information. I'm James Twomey, and welcome to the Twomey Stock Market Report. Thank you.